without further ado, we'll go ahead and get started, and I'll introduce our CEO, Gaurav.
Thank you so much, Anika. Well, good morning, everyone, and welcome to our panel on a forward conversation, impact on the real economy. My name is Gaurav Vasisht, and I'm the Executive Director and CEO of the New York State Insurance Fund. Before we introduce our distinguished panelists, I wanted to start off by giving a short overview of NYSIF, just as a point of context for today's conversation. So as we have this conversation, it's important to remember what NYSIF actually is. First of all, it's an insurance company. And it's the largest workers' compensation insurance company in New York State and among the largest nationwide. And it traces its roots back to the labor movement of the early 20th century. So it's been around for quite a while, for more than 100 years. Second, it's important to remember that NYSIF is a creature of statute. It actually exists in the law. And it was established as a state entity with a public purpose. But what's unique about it is its funding structure. It's funded entirely by premium income and investment income and not taxpayer dollars. So as you think about that structure, that's a very unique structure. There are not too many organizations out there with a public purpose and a private funding source. And third, and most importantly for this discussion, is that NYSIF is an asset owner of about $22 billion, which it invests as a fiduciary and as a long-term investor in the capital markets. So with that background, our conversation today is focused on the impact that investments and investment decision-making can have on the real economy. And by the real economy, we mean the non-financial segments of the economy. And what brings us to this dialogue, the impetus for this dialogue, is our obligation to injured workers. And we know that we can't meet that obligation to the injured workers if we don't ensure the long-term security and growth of our investment portfolio. Easier said than done in times of climate change. Lots of complexity, lots of challenges associated with that goal. And we address a lot of those challenges. We analyze those challenges in our climate action plan that we issued and published this past fall. And that climate action plan the anchor for that was a directive from Governor Hochul, and it focused on three components. The first is decarbonizing our investment portfolio. The second is financing climate solutions, and the third is collaboration and engagement. But how do we accomplish our objectives in a way that doesn't harm the economy, that has a positive impact on the real economy? How do we measure that impact? And how do we know when we've achieved it? How do we ensure a just transition for workers and for communities and keep small businesses in mind? And how do we cut through the greenwashing to make actionable decisions? That's on the agenda today, and that's what we're going to be talking about. And I can't think of a more informed group of people to have this discussion with than Sarah, Jose, and Roy. And to introduce them, I'm going to throw it over to Rajith Sebastian, our head of ESG and sustainable investing, deep expertise and knowledge and experience in the financial services sector, and comes to us from Wharton. So with that, Rajith, the floor is yours. Take it away.
Thank you, Gaurav. And I hope we have this interesting mic situation up here that we might need to share here, Jose. So, can you hear me at the back? Okay, great. So I'm delighted to introduce our panelists who are leaders in this field of sustainable investing and have a wealth of experience and insights to share with us. Please welcome Jose Minaya, CEO of Nuveen, Roy Swan, Head of Mission Investing at the Ford Foundation, Sarah Gelfand, Managing Director of BlueMark, and of course, Gaurav Vasisht, CEO of NYSIF. If you could give them a warm hand to welcome them. Yeah. And thanks. That was a good reminder on the phone. So if everybody could keep their phones on silent. But not just that, we'd like to do a short online poll in a second. So if I can ask if you can get your phones ready with your cameras, with your internet on, and we'll share a link shortly. So Gaurav actually gave great context on this. It's $8.4 trillion. That's the most recent estimate of ESG investing assets under management by the U.S. Sustainable Investing Foundation. Now, the estimates and the assessment of how big the space is differ a lot, but this is credibly a space that has grown almost tenfold over the last decade. Climate investing is a large subset of ESG investing that focuses on reducing greenhouse gas emissions and supporting a transition to a low-carbon economy. Now, the topic today of forward conversation, impact on the real economy, hopes to move beyond the prevailing ESG discussion on portfolio emissions and reducing risk in our own portfolios, and looks to discuss with authenticity the positive effects on the real economy, global emissions, economic growth, job creation, as Gaurav said, what's our injured workers and the rights of workers, and the overall wealth of individuals, businesses, and governments. Because with all this excitement and growth around ESG and climate investing, we have to ask the question, are we having an impact where it counts? And Gaurav went through some of those questions. How do we make sure that we're avoiding harm and creating value for society? Are we addressing the trade-offs and tensions that may arise between environmental, social, and governance objectives? Are we, in short, having an impact on the real economy? Now, I did promise a poll, and so let me hand over to my colleague, Anika Becker, to conduct it.
Great, thank you, Rajith. And thank you to everyone who's come today in the audience, and a special thank you to our panelists for participating in today's panel discussion, which is sure to be a forward-thinking discussion and the beginning of a much longer conversation. So as Rajith mentioned, my name is Anika Becker, and I'm the ESG and Sustainability Lead here at NYSIF. Before we dove into our discussion, we thought it might be interesting to hear from the audience on your familiarity with your views on a few topics related to our topic of discussion today. So if you could please follow the instructions on screen. You open up your browser and go to pollev.com, and it'll ask for a username. You could type in NYSIF. And then the instructions will be on each subsequent slide. So as we move through this, if you get lost, you'll be able to get back quickly. So our first question, relative to the current state of play, how much more influence do you think that an asset owner like a NYSIF can have on the ESG and climate investing industry? And these answers will range from a lot of influence to very little influence. So far, 100%. So I'll give everyone just a couple of seconds to start filling in these answers. So it's interesting. It looks like in the audience, asset owners can have a high to somewhat high influence on the industry, which is pretty interesting and I must say very encouraging for us at NYSIF to hear. Great, so it looks like about 66% think very high influence and about 35% say somewhat high. So that's, again, very encouraging to see. So thank you all for answering that. We'll move on to our second question. Oh, there we go, 65 and 35, a nice round number. So our next question, how familiar are you with the concept of impact on the real economy? So as many of you know, this is a framing concept for our discussion today. So it's helpful for us and for the panelists here to understand your level of familiarity with the concept. And as we go through the conversation, hopefully some of the topics that we discuss will start to pique your interest and we'll continue to develop that understanding today. So this one's really interesting. It looks like some people have some familiarity, and then it's a bit more mixed. Looks like we're more familiar than not, which is great because we could just kind of dive into the discussion, but we'll be sure to kind of continue framing the discussion and hopefully continue building on that and maybe bolster some ideas of impact on the real economy and start to maybe challenge some of those ideas as well. So that's great, and I think this really sets the stage well for our discussion today. We just have one more poll question, which I'll move to next. How confident are you that climate investing will have a positive impact on the real economy in the next 100 years? I'm sorry, 10 years. I don't know, maybe 100 years will start to skew the answers. So it looks like we're pretty confident that climate investing can have a positive impact on the real economy, which again is just really encouraging going into this discussion on our impact on the real economy and how we can, through our climate initiatives, really be impacting the real economy. So this is really, really encouraging to see, and thank you all so much for participating in our poll today. This is, again, really helpful for us as we move into this discussion. But now, and also it's just really helpful for us to get an understanding of where the industry sees itself and sees us. So thank you again. And without further ado, I'll hand it back to you, Rajith, and we'll dive into the panel discussion. Thank you.
Thanks, Anika. So let's begin our discussion with a level-setting question to all our panelists. Please provide some background to your company. What role does your company play in the sustainable investing discussion? Tell us about where you focus. Is it across the board? Is there a climate or social impact focus? Is there a thematic focus? Let's start off with Jose, and we can go down the line here.
Sure. This is, it's something that it's part of our DNA. Look at Nuveen, and we're owned by TIA, which manages money on behalf of professors and staff and faculty across universities in the U.S., which they care a lot about this. We also, of the 1.1 trillion we manage, a little over 300 billion of that is in real assets and alternatives. That brings sustainability into the mix. But no matter how we put this in context, I always break it up into two parts. The first one is investor first, meaning we look at this from a perspective of our job is to manage the risks of our participants and our clients. We're also a long-term driven investor. So almost every time we're going into markets, we've got a minimum of a 20, 30-year view of what we're doing. Sustainability is a key factor in that. Again, you go back to the real asset side. If we own a farm, we're looking to earn our returns over a 20, 30-year period. Clearly, it makes sense to maintain the integrity of that asset so that we can get our capital back. So we always take that first lens that what we're doing is really understanding the risk profile and how do we maintain the integrity of the assets that we invest in over the long term. The second piece then, it's like, well, what do our clients want as well? And that helps us in how do we attract, what do our employees want? How do we attract talent? And I always separate that story to what do we do holistically as a firm in terms of how we engage in proxy voting, how we engage in the meetings we have with management teams, the companies that we buy. Separately from, we manage over 50 billion in ESG labeled funds. That is more your BAU asset management, meaning it's a product, like you said some of the stats there, there's high demand for this. And in high demand, last year we launched 2 zero carbon ETFs. We have an impact-driven private equity fund. Across the board, this is us getting a feel for what is the demand from our clients. And in some cases, they're looking for more specific thematic investments. This is a big theme. And it's not just a big theme, by the way, because of the need to improve climate change, what we're seeing from a societal need. I often say there is a lot of alpha to be had in this space. I look at it as something as simple as infrastructure. Core infrastructure projects are you may be looking for a 4 or 5% return. You look at the same project that has same cash flows, same offtake with utilities, and you're getting an 8 to 12% return. And for me, that's just an easy place to go.
Great. Can you all hear me? Is it? Okay, great. Good morning, everyone. So you are looking at the luckiest guy in the world for a couple reasons. One is my beautiful family. The other one is the fact that I have the great privilege and honor to work at the Ford Foundation. The Ford Foundation is one of the largest and oldest charitable foundations of its kind. Our mission is to address the root causes and consequences of inequality in all its forms. And the way foundations work in the U.S. is the core business is giving away money in line with the mission. That's 5% of the assets under law. The other 95% is invested in the markets, often with no relationship or alignment whatsoever with the core mission of the foundation. There's an old joke. Did you hear the one about the Lung Cancer Prevention Foundation? They made a killing in tobacco stocks. The reason I have my job is because Ford Foundation President Darren Walker, who is one of the most brilliant people on the face of the earth, asked the question that some others had asked. We actually give away closer to 6% of our money every year in alignment with our mission because of Darren's vision. He says, well, what about the other 95%? Is there anything we can do with more of our resources within our fiduciary obligations that can be aligned with our mission? And that's why I was hired. I was hired to try to prove that case, that impact investing, double bottom line or triple bottom line investing is a viable strategy for an institution that has fiduciary obligations. After 5 years, we published the first report that outlined our impact investing strategies. We have 6 across the world, 3 in the U.S., 2 in the U.S., 2 in the Global South, and 1 that's throughout the world. And there was great skepticism about how this would all work out. People just didn't see how you could achieve both positive social impact and positive financial returns. There was skepticism from our board that was overcome through rigorous study. And there was skepticism once I was hired as to what would be the outcome. We published our returns, both social and financial, not to chest thump or to peacock feather strut, as I say, but to show the world that we should test our assumptions about whether you can generate positive impact and return. So we generated over 5 years compound annual return of 28%. Many people believe that we would be break even at best. And again, that's not something we're bragging about. We just put the information out there to challenge the common, the sacred cows, the common or conventional wisdom. So that's, I'll stop there so I'm not dominating time and hand it off.
Thanks. Hi. Also, good morning, and really, I also feel very lucky, very glad to be here in this room, and for many other reasons. I'm representing BlueMark. We provide impact verification services. For those of you who don't know what I mean by impact verification, we conduct independent assessments of asset managers, and we interrogate the degree to which their strategies are designed to and executing in a way that will allow them to deliver the impact they say they're going to deliver. So ensuring truth in advertising. And I'm playing a different role than the folks here in that I'm not representing any one investment organization. We have clients that span asset owners, asset managers in many geographies, working in many sectors and different asset classes. And as our market has grown, in order to maintain the kind of optimism that we saw in that poll that this kind of investing really can work, we need to make sure that folks who use the impact or sustainable label are doing it with integrity and are held accountable to that use of that label. And then I don't know how commonly we say this at BlueMark, but I sometimes think we're like secret decoder rings. There is a lot of acronym standard conflation, and it's hard to know when people say that they're going about their work in a way that is using best practices, whether or not they're really doing that. And so in a time of a lot of dynamism and sort of norming around what good looks like, our organization tries to cut through that noise and provide shorthand that allows folks who are just trying to understand what's really real and what's driving impact, that simple, accessible way to have confidence.
So NYSIF comes to this conversation as an asset owner, and we view it through the lens of our fiduciary obligation with an expectation of returns. So again, our obligation to injured workers is paramount, and in that, our fiduciary obligations are paramount. That said, we are new to the conversation. We haven't integrated much of this discussion in our climate decisions, in our investment decisions. But our initial work is captured in our climate action plan that we published last fall. And one element that's really interesting about that plan is the robust level of disclosures on our own portfolio emissions that it provides. And we did that as a measure of leadership. We did that as a measure to gain some credibility as we get involved in the discussion, the sort of the bigger discussion that's taking place on climate disclosures. So we started off by providing this information. We're going to continue to provide this information in our climate plan and continue to advocate for greater disclosure so that we can have the data that we need to make informed decisions in this space. Beyond that, and beyond our climate action plan, our goal is to integrate ESG factors. This is aspirational. This is work that we're doing, Rajith and Anika are doing, others are doing. But we want to be able to integrate ESG factors across our investment portfolio and consider these factors in making decisions. We view it as a risk management tool and a risk mitigation tool, and we view it as foundational. And I will say that when we talk about integrating, we're talking about both quantitative and qualitatively. And that's sort of the aspirational goal here in terms of ESG risk management. We are also considering, and to the extent we pursue impact investing, we would do it as a small portion of our risk budget. And we would do that in a very thoughtful way, very intentional way, with an expectation of returns and some mechanism to measure the impact that we're trying to have. And when we talk about impact investing, I want to be very clear about what I mean. We're talking about generating a return while also having some influence in solving some social and environmental problems. Because the general thesis is that we can generate a market return while still doing some good. But again, all of that will be very much in line with what we're trying to accomplish, very intentional, thoughtful, focused on returns aligned with our fiduciary obligations and with some measure of looking at the impact. And as I think about all of this, it strikes me that it's all about decision making. And decision making is a web of choices with lots of different trade-offs. But as we make these choices, we want to have a level of confidence that the decisions that we're making have a positive impact on the economy. And I mean this overarchingly. And for that, we have taken on the ambitious work of coming up with a framework that looks at impact on workers, impact on global emissions, impact on small businesses, and other elements. And we're drawing upon a lot of the academic literature that's out there, a lot of frameworks that already exist that are in wide use, to give ourselves a level of confidence that the decisions that we're making are actually having the effect, a positive effect on the economy. And to the extent that there are unintended consequences, we take account of those as well. And that's work that we're looking forward to doing, drawing upon experts, drawing upon a lot of your expertise, and look forward to taking on.
Thanks, Gaurav. That was really helpful context. And in fact, as you said all of that, it seemed to me that impact investing, as much as one might focus on it as a narrow part of our portfolio, what you were talking about actually seemed to incorporate thinking about impact across our entire portfolio. And so, I'm quite interested in the next question, which is, why is impact investing, as you mentioned, to maximize social and environmental impact alongside financial returns, equally important in the ESG and climate discussion? Is it complementary to ESG or climate investing, or are they trade-offs? And here, I think for all the panelists, I would love you to link it with, your personal or professional journeys, because it's interesting to kind of hear why is impact something that you would prioritize. So maybe Gaurav, you answered some of this in the last question, but maybe you can start and we can go the other way.
So I love the linking aspect of it, and I view that as what are we anchored to as we have this conversation. And the anchor for me, as I think about it with respect to the work that we're doing, is the Triangle Shirtwaist Factory fire, from whose ashes this organization actually emerged. About 150 people died in that fire. It was March 25th, 1911. And it prompted a lot of change, and one of those changes was the establishment of this organization. When I think about those people, the people who died, symbolically, for me, they represent the claimant population that we serve, and they represent the real economy as we perceive it. These were people in the real economy. And so that as a sort of a framing point of reference, as an anchor as we do this work, is very important for us. So with that in mind, ESG for me, again, is a risk management tool. We want to integrate it throughout the investment portfolio. Impact investing in the traditional sense, We are looking into whether we can do that, and if we do, it would be intentional and within our fiduciary obligations. I think both of those concepts are very important. One is a risk management tool. The other is generating a return while solving a social or environmental problem. Both are important, both fit together, and sometimes there are trade-offs and sometimes they don't necessarily align with each other. More broadly, as we talk about the overarching portfolio and we talk about impact and those decisions, I think it's very important first to do no harm, and then secondly, to be able to measure what we are actually doing and accomplishing in terms of impact in the real economy, and to constantly stay true to that overarching objective. And it isn't easy. It's very ambitious to do that, and really look forward to putting that analysis together.
Sorry.
Well, I might tackle the first part about how I think about the difference between ESG and impact investing, and then I can share sort of my personal motivations. But when you asked if I think impact investing is different or part of, or how does it relate to ESG investing, I do think the ESG industry has matured. We're at a point in time where the tools exist and are sophisticated enough that most investors can easily or accessibly think about the extra financial risks associated with their environmental footprint, their labor practices, all the issues related to ESG, and in doing so account for financial risks that may hinder their fiduciary obligations. But impact investing goes above and beyond. Impact investing is about putting money to work in places where there's a strategy and an intent to drive change. And we need money to go to work to drive change. I don't think I need to say this to the people in the room, because most of you are here because you believe there isn't enough money fueling innovation at scale that can really make a difference. And reports come out that talk about how far and how severely underfunded our progress is towards the SDGs, just as one framework. And we can't fill an $100 trillion gap in financing or above with government and philanthropy alone. And so the private capital needs to flow, and it needs to be flowing in places where it's trying to solution, not just minimize harm. And personally, it may sound trite. I come to this work because I've spent my career trying to sit in places where I thought I could make a difference. I've worked in nonprofits, I've worked in research centers, and I've worked in for-profits that have been funded by impact investors like I do now, and for-profits, in full disclosure, Ford is an investor in my company. And I have worked in companies that have not been funded by impact investors. And I believe in the potential of capitalism that's well-intentioned to be a force for good, and I want to dedicate my career, as I have for the past 15 years, to making sure we do that in a way that works for more people.
So at the Ford Foundation, we too see a clear bifurcation between ESG and impact investing. We see ESG as a disclosure framework, and impact investing, the way we approach it at the Ford Foundation, and by the way, for both ESG and impact investing, I say it's like snowflakes. No two definitions are the same. Or for every person on the face of the earth, there's a different definition of ESG and impact investing. The way we approach impact investing with our endowment capital is we identified big social problems where we believe we can achieve risk-adjusted market rates of return. So that's our focus. I should also, so our 6 themes, because I referred to them earlier, in the U.S., multifamily affordable rental housing, and that the big problem there is massive shortage of affordable housing. Diverse fund managers, and the problem there is, I'll just say, in a capitalist system, if you don't have access to capital, what you do have is a problem. And according to research by Professor Josh Lerner of Harvard Business School, investment firms owned by women and people of color manage 1.4% of the 80+ trillion in assets under management. That is a big social problem, and I believe that every socioeconomic problem in this country stems from that devastatingly destructive disparity in access and control of capital. We also have a strategy called Quality Jobs, where we believe that that superior operational design, that's classic business school 101, plus superior human capital investment, type of investment in people that actually can help address the current 80% disengagement rate of American workers, can generate superior financial returns. So that's U.S. Outside the U.S., financial inclusion. These days, that's fintech across any number of sectors, and healthcare, biotech. We also have an inclusive capitalism category that's almost sort of a catch-all for very narrow areas of focus as we find them. But I just want to say, in terms of what I love is that I think captures so much of the spirit of what businesses should be all about is set forth in the Johnson & Johnson Credo. I don't know if any of you have read it, but it was produced by Robert Wood Johnson, member of the founding family, and basically lays out the responsibility of the company. The first responsibility, they say, is to the customers. Second is to employees. Third is to communities in which, and that's writ large, including responsibility to pay an appropriate amount of taxes. Imagine that. And they say if we do all of that and we do it well, our shareholders will do very well. They will receive a fair return. So I think that's just a beautifully stated motto for all of us, whether we work at companies, we own companies, or we're investors. So I'll stop there.
Yeah, I think Roy said it really well. I'm going to hang on to a couple of things he said. One, I agree that ESG is somewhat of a disclosure tool versus impact is now measuring, again, an impact, and you also can measure that as a return. Obviously, the two intertwine often as well. But like I said before, when I look at all these topics in two lenses, and the first one you've heard from the panelists on several discussions, this issue of double, triple bottom line. I very much believe everything we do. You heard about fiduciary duty, trade-offs. In my opinion, there is no trade-off to our fiduciary duty. It's why we're here. There's things we do that are charitable. We have a charity organization. But when we're investing billions, we're supposed to get a return on that. And that is very clear. I also very much believe the two are intertwined. I look at areas of impact investing, and there's a lot of alpha to be had. Give you an example. We recently became the largest manager in the world of affordable housing. We see a massive demand-supply imbalance out there. We see a massive social need. We are now to the tune of almost $10 billion invested in this space, and we can make good returns for our investors doing this as well. And there's kind of where you kind of get that triple bottom line, and you check that. Now, the second piece, though, is the one that you cannot overlook with impact investing. There is an emotional connection to this. We created a purpose at our firm, and our purpose statement is we invest to create an enduring impact on our world. Because we realize that all this bottom line stuff in our fiduciary duty, that is not necessarily wholly why people come to work. They want to know that there's a purpose why they're here, that there's an impact. Part of that bottom line is how are we going to attract talent and come here? How do we connect your personal story to what you care about to kind of bring your best talents to work that helps drive that bottom line? So it's a thing of how do you attract clients? How do you attract talent? For me, I love working at a firm where my parent company, TIA, it's all about retirement and helping people retirement with dignity. For me, it's about something you said, Roy, that's really important to me in our firm. It's access to capital. It's where net worth is built. Listen, I grew up not too far from here, Washington Heights. My dad worked in kitchens. My mom was a housekeeper at the Waldorf. Largely, if I look at my own community, Hispanics and Latinos, they generate purchasing power of almost $8 trillion in GDP. Yet less than 20% of that community has access to a retirement account or retirement securities or advice. And I go back to that bottom line. It means a lot to me to break that cycle. I broke that cycle. I see what it means for my kids. I see how I'm contributing to society in different ways. the massive power. Like, this is what this country is built on. Different levels of immigration coming in, driving that innovation, bringing in access to capital, what we do, how we impact lives, that matters. So I always start out with fiduciary duty. Bottom line, we have to do that. They're intertwined though, because how do you get people to come work for you and do this? There's an emotional component to this that it just matters. And it's so easy today to get caught, woke up, this is woke, this is this. This is just facts. This is just an obvious thing around how do you come together and drive real results for the overall society within our own fiduciary constructs, and then create a meaningful place where you want to attract the best people to come work for you.
Wow, what a powerful story there, Jose. Thank you so much for being open to sharing that with the audience. And I think what you said and what others have said on the panel here in terms of the intertwined nature of the ESG and impact discussion is basically how we're thinking about our sustainable investing framework. There's a lot of research out there that shows that the negative externalities that you might have from, for example, divesting in coal or putting in wind farms in some specific areas can come back and bite you over the long term. And so as we think about climate solutions and solving for our risk, we're advocating for more thinking about the long term, what are the impacts of those solutions on global emissions, on underserved populations, et cetera, et cetera. So it's complicated, but I love the intertwined nature of things that you mentioned. So we're, of course, short on time, as every panel is nowadays. So I'm going to combine a few questions together. I'd like to talk about balancing balancing returns and impact. And this is a topic that has come up recently. Is it in our fiduciary duty to think about impact and think about maximizing returns? Can you do both? And also, how do you actually assess or measure impact? So if I could start off with Roy and then Jose and Sarah, if you could combine some of those answers.
Yeah, so I guess the first comment I'll make is that I think this all this work we're doing around ESG disclosure is really great. And as time goes on, the concept of externalities, I believe, will take over, because ESG is just a beginning, capturing disclosures and then figuring out how to quantify those externalities that are disclosed, both positive and negative, and then that becomes integrated in investment analysis. So I think we're in sort of an interim phase. Sarah mentioned that we invested in BlueMark, her company, and that was after kicking and screaming on my end. I was completely and adamantly against what BlueMark was doing, which I felt was putting a tax, making it harder for impact-oriented entities to go about trying to generate impact, because this is it's already hard enough to try to make money and generate positive impact in certain instances, so why add on top of that this burden? But then there was a conversation, I'll never forget, during the pandemic. I was on Lexington Avenue taking one of my walks instead of going to the gym, because the gym was closed down. And there was a pivotal moment where I realized, this is absolutely necessary, and Ford Foundation became a lead investor. The idea that impact and investment returns can achieve is we believe it's all about making good choices in your allocations of capital, which involves traditional rigorous diligence along with an understanding of whether the impact you expect is in alignment with what you're trying to achieve. And I know we're short on time. I could talk about this forever. I'm going to stop and hand off.
Yeah, I'm going to continue to piggyback because I think that these are great comments. And one, I firmly believe that there's plenty of opportunities where you don't have to weigh the impact versus the risk. There's opportunities. I mentioned affordable housing. There's a lot of different things we're doing where you can go out there. Gaurav said something, though, that is really important. Where you get in trouble is you should also strive to do no harm. There's plenty of places you can go that are going to stretch those lines around. Are you making that compromise there? And that is where the hard discussions come in. I think, Roy said something where it's critical here. It's how we engage with our portfolio companies and clients. Transparency is key here. What Sarah does, this is where the future's going. And people always ask me, like, is ESG real? What's going on? They're not asking that anymore. But part of what I used to say 7 years ago, you know when it's going to be real? When you start seeing the regulatory environment come in. When you start seeing this becoming political. Now you know someone struck a chord, and this is real. And this is what's happened with every single one of our asset classes, right? So I think transparency is important in how we're impacting and engaging. I'll give you an example. We get attacked at times. We engaged a coal company, and they issued a specific financing around building a new renewable facility around solar power. We're not investing in anything else. We got attacked. How could you be worried? I'm like, isn't that good? We are engaging with a fossil fuel firm saying, transition is coming. You should be thinking about these things. Hey, we buy this academic exercise. We'll start investing in solar. That is a good thing. So this goes back to this do no harm. What conversations are we having? This politicized environment. Our jobs here is stay in our lanes, make our impacts, and not get caught up in all this other noise.
Maybe the only thing I'll add to this conversation is that, as has been said, there's a lot of reason to believe there's alpha or meaningful returns to be generated in sectors that are driving impact. So then the question asset owners and discerning asset allocators ought to be asking of fund managers is, how are you optimizing for impact? How are you looking at those things side by side? What in your investment process and processes are you doing to make sure that you're set up to achieve impact goals? And what are you willing to be accountable to? And I think it's not okay anymore for folks to call themselves impact investors and not have a clear and robust set of measures, be ideally setting qualitative, if not quantitative targets. Consider, by the time they're raising Fund 3 and Fund 4, setting impact incentives linked to those targets, and just generally be in the business of doing impact the same way you're in the business of generating financial returns.
Yeah, that's excellent, and agree 100% in terms of the need for measuring and quantifying this impact more. But isn't this impact space for foundations, Roy, academics, and niche funds? What is the role of large asset owners and asset managers in this impact discussion? And I know a lot of asset managers out there, we get this question a lot. Why are you talking about impact? We're talking about ESG and climate. And so, Jose, maybe you can start and then we can go, I know Sarah has a perspective on this, and Gaurav and Roy, if you want, you can feel free to chime in.
Well, sure. Our responsibility and our role in this, again, it does start out with there is that fiduciary duty and there's an ultimate return profile we're trying to deliver. But then it's also our duty and our role in how we influence our markets. You hear the BlackRocks and the Vanguards, and these are passive funds, yet they have tremendous power in how they vote their proxies. That is a responsibility that you have and you're given. Now, the question is, with all the proxies we vote, the meetings we have, how are we influencing our environment? How are we engaging? What is the stance we're taking? Are we divesting, or are we kind of leaning in and trying to kind of help that benefit? Transparency has come up. This is another one where part of what's issue in this industry, you talk about SFRD, all these things coming up, there's not a lot of consistency, tons of acronyms. Now you're seeing the SEC show up and they're giving fines because somebody puts a label on this and said, this is ESG. And someone's saying, well, no, it is. It's not. Well, what does it mean? What are the rules? Our role is trying to help to provide, as always, clarity, transparency, to create an environment where we have a respectful engagement with these companies and try to influence to drive better returns.
Over the past few months, I've been talking to a bunch of different asset owners and asset allocators as part of a research initiative we got some grant funding to do. And I would say from large pension funds to small family offices, there are all parts of the asset owner and asset allocator universe that are trying to get into this market for a lot of the reasons that have been said here. It's confusing and upskilling is hard, but the opportunity space, the real benefits to society, the long-term impact and financial returns are all things that folks can't ignore anymore. And so I think we're past seeing this as a niche, and I also agree that the regulators in the EU, in the UK, and in the US are all signaling a similar conviction that this is a place to invest in, here to stay, and what we really need to do is safeguard it now, not keep it on the margins.
So real quick, I know we're short on time. I echo everything that's already been said. I think the role for asset owners really is a role about influence and being able to kind of influence the conversation and take it forward. I just want to echo something that Jose said about clarity and transparency. I think that is fundamentally important to all of this. Knowing the rules of the road, understanding those rules, but then also data as we go about our journey to actually influence and have these conversations, being armed and equipped with information and data so that different definitions don't mean different things, different data sources don't provide different output. I think that becomes very important. Having a standardized definition, having data, having the opportunity to rely on that data to push the conversation forward becomes very important. And I think the regulators are actually doing very important work to provide asset owners and investors, all the information they need to actually have an influence and be a part of the conversation.
I just want to add one point. So I know I started out with my lung cancer prevention foundation, making a killing in tobacco stock. Something Jose said reminded me of another little quip, and that was, the planet got destroyed and our capital's all burned up, but didn't we make great financial returns? And so I don't think I need to translate that, but I think the do no harm point that Jose made really captures the point. So I'll stop.
So maybe we can stick with you, Roy, because just on that topic, there's a lot of discussion around this climate transition, the ESG transition, and the negative, how it's disproportionately impacting underserved groups, people in emerging markets. And so the topic is the just transition. So just very curious, do you have any views of what is this just transition and whether there's a cost to this just transition? And if there is a cost, who is responsible for that? And maybe Roy, Sarah, and Gaurav.
So again, I'm going to turn to something that Jose mentioned, which was the idea of engaging with a coal company that's trying to manage a transition into renewables. I'm a firm believer. Look, we can't shut off fossil fuels today. If we did, we'd be dead within whatever short period of time. So I believe that engaging with everyone for the greater good, strongly agree with that. I wrote an article in Fortune Fortune magazine that kind of talked about some of the interests we need to think about. So you have people who are working. I mean, how do you expect another outcome from the current politicization of ESG when you've got people whose livelihoods depend upon their jobs at fossil fuel companies? I mean, and whose wealth. So you have to expect some volatility in the discussion. But at the end of the day, we believe that a just transition is one where there's transparency in approach and there's partnership at the public sector and the private sector. And we also have to think about the use of the word cost. I mean, words are important. And cost can also be considered investment as a term. And so I think if we look at a lot of the funding that we do at every level, including the government, it's not just about spending or cost, it is about investment. So that's, I'll stop there.
I mean, again, I'm coming at this from a slightly different perspective and thinking about the role of measurement tools to drive more accountability, which has been discussed, and also more transparency around what organizations are doing to ensure a just transition. And one of the great things about all the work that has gone in the impact investing community over the past 10 years to build measurement tools and frameworks is that there is a sort of established set of resources for folks wanting to make sure they're being accountable to their stakeholders, make sure they're thinking beyond just one sort of singular impact outcome and looking at all the dimensions of impact that they're generating and achieving. And I really liked the credo that Roy shared at the beginning from Johnson & Johnson, and I think if more folks were measuring and thinking about accountability to not just their paying customers, but their employees and the communities and the environment, then more of us would be in service of a just transition, and I think we have the mechanisms to do that.
Yeah, for me, when I think about just transition, I often think about workers and I think about communities. And I think that that's very important. And I think the cost associated with a just transition, and I keep coming back in my mind to what the cost would be of an unjust transition. And I think it would be much higher, and I think the social consequences would be enormous. So keeping a focus on just transition, keeping a focus on the real economy, real people, real workers, real communities as we transition, not leaving anyone behind, I think that becomes extremely important in the work that we're doing.
Excellent. And so we're on to our last question where, this is really a call to action. And so I'll give you a few seconds to think about what your call to action might be. But right after this, we're going to move into Q&A. So I'll also ask the audience to please think about what questions you might want to ask. So what is your call of action, panelists, for the audience here today? Feel free to share any final thoughts, any kind of research you think or other resources you think the audience might benefit from, or any takeaways you want to leave with the audience. And if you could keep it to a minute each, that would be great. So we can go down this line.
Sure, I'll keep it very simple. I think one is a fact and one is more of an opinion. The fact is, call to action is you all have some level of influence, whether it's in your communities, whether it's at your work, whether it's, pressuring, asset managers. The call to action should be think about how you can use that influence because it's powerful. It's what drives decisions. The second one that's more opinion is that I look at this is an incredibly complicated topic. And it is a mistake to look at this as a black or white issue. Just get rid of this, just get rid of that. Engage in the both sides of the story, really trying to understand what these issues are. Because what's even more dangerous in the do no harm is that you have tremendous influence and it's directed in the wrong way.
So I'm going to appeal to enlightened self-interest. And I'm going to say that when I mentioned the reason why we have diverse fund managers as one of our strategies is if you look at since 1990, the cost to the U.S. economy for maintaining race-based systemic barriers to access to opportunities, whether it's capital or equal opportunities of jobs, et cetera. For black people in America, the cost, $50 trillion. Some of that could be captured in investment portfolios. That was Pew Research, and I think Citi came out with research saying that in 5 years, if race-based barriers to opportunity were eliminated, $5 trillion could be added to the U.S. economy. So when you think about what's good for humanity, what's good for this country is good for your portfolios. So I would say think about that as you're making your investment decisions and as you're interacting with some of the decision makers as you determine how you're going to allocate your capital.
Well, Jose and Roy are hard to follow in general on this panel, but I was going to say what Jose said about influence. I think a lot of us don't realize the influence we have, and I encourage in all the ways you can use your own voice and capital to make change that you do so. I think the other thing I'd say is expect more of yourself and the folks you invest in. I think there's a lot of just good intentions that keeps people from really interrogating or opening lines of inquiry about the hard questions about what do you really mean by impact and what are you prepared to be accountable to? And I think the more we pushed folks for more precise and clear answers, the more we'd have a field and a body of work that could stand up behind its claims.
Real quick, I think investing in companies is a major responsibility. and it has consequences for the economy. And as a large, as an asset owner or as a collective of asset owners, being able to exercise influence becomes very important. It's how you exercise that influence that matters most, in my mind. Are you data-driven? Are you asking the right questions? Do you understand the subject matter? I think those are things that are very important for us here at NYSIF as we start this journey. Speaking in terms of NYSIF's own trajectory, we are really excited to be a part of this conversation. We are really excited about rolling up our sleeves and understanding what's actually happening as we make those decisions. We're excited about coming up with a framework that will help us gauge our level of confidence as we make those decisions and move forward. And I will focus, as we mature in this journey, on the interaction between asset owners and asset managers and where there are synergies and what obligations and duties there are between the two of them, because I think there's a big role here for asset managers in terms of guiding this journey for us as an asset owner. So really look forward to kind of shaping that and giving it contours in terms of NYSIF's own engagement with asset managers.
I thought those were fantastic takeaways. So thank you all panelists. Let's give them a quick hand of applause. So over to the Q&A section. If I can ask, when you ask your question, just your name, which institution you belong to, and then the question. Please don't frame the question with a very long introduction to the question. Just one question, straight and direct. What is the question? So that's one, and please only ask one question. The second is we'll probably rotate between this side, and I'll choose a few people on this side, and Rohan and Ingrid standing at the back will rotate a mic to you. And that's really it. So very, very excited for your questions. So we already have two questions here. We can start off here at the front, and then over there. So we have, Any questions on this side so we can just tee up? There's a question there at the front. Thanks, Ingrid.
Thank you, panelists. This is such an interesting and encouraging discussion. I really, really enjoy it. My name is Yi Chang. Just think of the word Hawaii without the ha. And remember my name, Yi. And I work for Lafayette Square. My question is specific for Jose, because we're alumni. I went to Tuck School of Business, just like you did. It makes me so proud to hear what you said and what you do with influence, leveraging the Nuveen platform. Your comment about how impact investing has an emotional connection with employees, and it actually helps you to attract talents. I thought that comment was really interesting. I was just wondering, with that, how does that impact the culture as well as the productivity of your people at Nuveen Capital?
Sure, no, and thank you for that. And it's an appropriate question coming from Lafayette. Good on you. But and you guys are doing great work. And you kind of think about impact. Look, I think when I look at the topic of culture, and as you pertain it to this, I've always said culture beats strategy any day. We can have a crappy strategy, but you have a strong culture, you'll persevere, and kind of the opposite, vice versa. And to me, it's a balance of, for a broader enterprise and kind of what it would mean. What are the tenets of what when we're talking about impact or ESG or anything otherwise that is really unifying, right? And let's think about that. And then I put that more into our values. There's zero tolerance there. Everything else from that, though, is recognizing that I am a big believer of multiple cultures, because I live in a world where I may have a real estate team and then a muni team, an infrastructure team, a farmland team. And when you start really getting into the weeds of impact and kind of what it is and how do you influence it, it's very different, right? And then how do you attract the best talent? How do you attract the best thinking? You have to allow that culture to breathe. You want something unifying, but as it goes throughout your organization, you do different things. You have to allow it to breathe, because it's going to mean different things. And then you may not be good. You may be good at 3 things and not 5 because you got diluted. I always say our real estate team doesn't want to come work at a large diversified insurance company. So how do you kind of create an environment that they're there so that they do want to come here? It's very similar to that.
Yeah, go ahead.
Thank you for the great panel. Connie Keita, I'm the principal of TBG Rise Climate. I would say at our firm, we're between maniacal and paranoid about our impact underwriting. We have I do the financial underwriting, we have an arm's length team that does all the impact underwriting. And both thresholds need to be met. I'm curious to hear from some or all of you, Gaurav mentioned this explicitly towards the end. What are the things that you see investors doing that you dislike, would like for us to do less of? Because I think it's fair to say we're doing our best to make sure that we're authentic and forensic in our underwriting, but we're not perfect. So when you're looking at different investors, what are the pitfalls that you see us falling into?
So Roy, can I ask you to answer this, and we'll just to save time.
Yeah, the most important things for us are authenticity and transparency. We don't let perfect be enemy of good, and we assume that everyone can learn as they go and share as they learn. So for us, if there are challenges facing, you made mistakes, just let us know. And we enjoy hearing stories about failures and lessons learned, because that tells us, okay, these are people who put themselves out there, may not have come out the way they wanted, but they got something out of it and are willing to convey that in a way that's helpful for everyone.
And who would, yeah, so we've got a question here next, and anybody on the left-hand side and there in the middle. All right.
Hey, Brandon Connolly, JP Morgan Asset Management. Great to see a couple of former JP Morgan people on the panel as well. My question, really briefly, climate litigation financing. There was a great piece in the FT over the weekend about the impact that climate litigation has made in pushing a lot of these real-world solutions forward, or at least stopping or holding people accountable. How do you see that type of investing activity or that financing activity as fitting into real-world impact portfolios or into the broader ESG investing spectrum?
Anybody want to take that?
Well, I mean, I think what that touches on is, and it's something that I'm also pretty passionate about. At the end of the day, that also kind of touches on an issue of people will come to asset managers looking for these solutions. Again, this is a complex issue. You're going to need the public to kind of get involved. You're going to need policy, regulators to come into this entire ecosystem, right? You talk about a carbon tax, these things. In many cases, when I talk about transition and where you may be anticipating policy going, that's part of managing risks, right? If you knew you may get a carbon tax coming, you may kind of invest differently in your portfolio. So again, it goes back to that influence. There's just so much we can do. But there's a broader ecosystem. It's like, well, is there going to be litigation behind this? You go back to guns. Do you own them? Do you not? Is it in your portfolio? Well, okay, what's coming down the pike? So from my vantage point, I look at those pieces and say, I got to use that information and think about how's this going to impact my portfolio. But then I'll sit back. I have my own personal views, but I'll sit back, and if you talk about carbon tax and these things, a big part of that story, well, that's the government's job. We can't do that. So again, I think it's that broader ecosystem, but from a manager's perspective, you got to be aware of all these different moving pieces, because if what you just described really kind of kicked off and accelerated, you're going to have some major impact in people's portfolios.
Thank you all for your views and insights. My name is Haben Berhe with the Principles for Responsible Investment. Throughout this morning, I've heard a lot of agreements amongst you and not a lot of disagreements. Is that risking groupthink within our industry? If it is, what do you see that's worth having discussions around that you guys disagree on, both from the asset owner perspective and managers as well? Thank you.
Who would like to take that? Gaurav? You wanna, or Roy?
Roy, why don't you go?
I'll just say briefly that first of all, I didn't see this necessarily as a forum for debate. We were responding to questions, so that's just kind of a format thing. We weren't set up to debate. The second thing I'll say is when I said that ESG and impact investing is like snowflakes, like no two definitions are alike. I mean, that's kind of the debate that happens amongst us, and I think if we're all trying to advance the common good, we can have productive debates, civil debates. And I think the third thing I'll say is, so I'm formerly on the board of the SASB Foundation, and someone mentioned the point about there's so many standards out there, it's really hard. Well, the decision of the SASB Foundation, or SASB, to merge into ISSB is one way of resolving what could be perceived as a disagreement. And that is the idea of blending standards. So SASB becomes the sacrificial lamb for the purpose of advancing the greater good to drive more standardization. So appreciate your question. We do need to, all of us need to engage in productive debate. And I don't see that, whenever you get a bunch of smart people sitting around, present company excluded, there's going to be disagreements, and we can productively disagree.
Well, I think Roy said it all.
Right. All right, we had a question there, and then we have a question there too, Rohan, afterwards. Any questions on this side, right here at the front? Go ahead.
Thank you all for being here today. My name is Gopa. I represent Huberger Berman. My question is for Gaurav, since we have NYSIF's climate action plan in front of us, but really anybody can chime in. What do you think is most often overlooked in most asset owner and manager climate action plans or green sustainability strategies, and what is your advice on filling that gap?
So I don't know what's often overlooked. I haven't examined everything, but as I said, I think the one element that the NYSIF plan has that we were very deliberate about was we started our journey with disclosure of our own emissions. I can't emphasize this enough. We actually went in, we did a full exercise, a portfolio review to determine what our emissions look like, and we disclosed them in the action plan to provide a baseline of what we're starting off with. We intend to use the data as more data becomes available, better data becomes available, to be able to periodically update those numbers and actually show how our emissions, portfolio emissions, are declining over time. So we're really proud about that disclosure, and I think more broadly, really excited and interested in engaging in the debate on greater disclosure, because I think more data, more information will help asset owners make critically important decisions.
Okay.
I'm Liz Smith with AllianceBernstein, and I really appreciate the panel and raising the attention of this important topic. You talked about something, Roy, about the low percentage of diverse and women-owned managers, and the importance of raising that so that we can get groups like that to make an impact in the investment environment. This is something we struggle with, and so I'd be interested to know how, Jose, you and Roy and Gaurav, what you're doing to tackle that, to increase the numbers.
By the way, this has been a big focus on our end, and I often say this is the same thing on the hiring front. I always tell people, you first have to acknowledge and admit that part of the issue is that our existing process is extremely efficient and works. Hey, you've got folks sitting trying to allocate $100 million or $1 billion. They can go do that pretty quickly in an efficient way, and it's going to leave all these people out. I can go want to hire data engineers, and you know what? I can go to Stanford, MIT, UCal, pick a few, get 1,000 resumes, put a GPA limit on it. That's pretty damn efficient, and I think you all agree I'd get pretty good engineers if I did that. That is the issue, and what we're trying to do now is break through that. And it's hard to break through that, because first you have to release people from their concern of, like, no one's going to fire me for hiring the Harvard person or for hiring, Alice, Bernstein, for example. So that one is like releasing from that and then creating a format that says, well, no, we're going to actively put more resources and grow. We started an inclusive capital program this year. And it's one where now it's real targets. We've had to hire people directly to focus on that, because otherwise, if it's part of a broader thing, anything that is like 5% of your job versus the other 95, So the short answer is you have to be intentful. This is not people, in most cases, it's not people that they're really trying to exclude. It's just that it's so damn easy to do it the way we all do it today. And that's just the truth. Like if I had to deploy $1 billion, I could do that pretty quickly. But to do that, I'm probably leaving off a segment of the market that has not had these opportunities.
Can I ask, just in the interest of time and also balancing out the question, Sarah, you've worked with a lot of asset managers and asset owners. Would love your perspective on that question.
Yeah, thanks. I think it's true if you don't measure it, it doesn't happen, right? I think really being explicit about goals and commitments and ultimately transparent about them is an important part of what is going to need to happen for folks to invest differently and put in the effort to do things outside of kind of business as usual. People talk a lot about financial risk when they are investing in managers that are first-time managers, and they don't really talk about the impact risk of not investing in diverse and underrepresented managers. And I think if we brought more of an impact risk frame to our assessment of opportunities and putting money into places that have been underinvested in, I think we'd see more money flowing.
And Rajith, I appreciate your sensitivity around the time, but I would like to comment on this point. So I mentioned the 1.4% statistic earlier. The portfolio I run is 65% of our portfolio is diverse fund managers. So I'm going to go through a few things for everyone's consideration. One is testing assumptions. So there's assumption that whenever the words impact or diversity or race, there's the assumption that that means underperformance. And if you believe this, we focus a lot on science and statistics. If you believe the statistics put out by Professor Josh Lerner at Harvard Business School, he says that there's no statistical difference. And in fact, he goes further, and I'm careful about this, he says that when it comes to racially diverse black fund managers, there can actually be outperformance versus peer groups. But I don't like to talk about that because that can put people on the defensive. It's like, so that's one. Two, and I think Jose mentioned this, there's got to be intentionality. And again, science says that white men have the most homogeneous portfolios, investment portfolios, and black people have the most diverse investment portfolios. And that is a reflection of Darwinian tribalism, I'd call it. There's just a comfort people have with their affinity groups. And you have to work. That's why the term intentionality. You really have to work to break through that bias. That's one of the reasons why I talk about the cost, and this is truly cost, of having such a devastatingly destructive imbalance in access to capital. The U.S. lost $50 trillion in estimated productivity, GDP, since 1990 because of blockages in access to capital. And then finally, I'll say incentives. I used to make a joke that if fund managers were compensated based on generating the best returns with a portfolio of investment managers who reflected the population, the complexion of the investment management industry would change overnight. So we have to think about the incentive systems. Thanks, Rajith, for your patience on that.
No worries, Roy. I think very, very important points, and I'm so glad you chimed in there. Thank you, Roy. Unfortunately, we're out of time. I know we had additional questions, but if you can come over and you can ask those questions directly to the panelists afterwards. I just want to round off this discussion. I mean, we heard a lot of things here today, but the topic was a forward conversation, impact on the real economy. And this was about thinking differently around the whole ESG and climate investing space. Certainly at NYSIF, we're looking to incorporate more of impact investing and thinking through the impact that we might have, the externalities we might have through ESG and climate investing into our ESG and climate investing process. So I would say, this is something actually that is debatable. And, I know there were some tensions here as we were talking about it, but it is a little bit different to what we believe is mainstream. And we would love to engage you asset managers out there in talking more about that. But some of the things that came out during the panel were fascinating. I mean, Jose, your personal story, thank you again for sharing that. And what I took away from having influence, but doing it in a balanced way, not being too much on either side, I think is important to take away here. Roy, you had a point around what's good for society and the environment is good for portfolio. And how relevant is it when you talk about racial equity and that being good for us as society, that being good, linking that to how important that is for one's portfolio. Sarah, you talked again about maximizing influence and the need to push more for transparency. And that's something that we believe too. We need to become more active, perhaps more provocative in this discussion to push more. So thank you for that. And Gaurav, my boss, I better come up with a good asking the right questions, making sure that we have a framework, and really the responsibility and the linkages between asset owners and asset managers, drilling into what that is and what that relationship needs to be. So on that note, if we could give this time the biggest hand of applause that you've done this afternoon. Thank you very much.